Welcome to the Geek Investor podcast, where technology meets investment insight. We break down the mechanics behind breakthrough innovations and uncover how they shape the future of the world's most investable companies.
If you're passionate about understanding not just how tech works, but how it builds real business value and investment potential, you're definitely in the right place.
Like, subscribe, and let's explore the edge where engineering meets equity.
Hosted by Ethan and Claire, and for full transparency, these are synthetic voices powered by Notebook LM.
Okay, so today we're diving deep into something really critical for anyone looking at investments. How do you actually figure out if a company's moat is strong and, if it's going to last?
Yeah, the moat idea, the defense against competitors, we've talked about it conceptually. But this is more about the how. How do you go from just knowing the term to actually evaluating if it's real, if it's durable?
Exactly. That's the mission for today. Because let's be honest, every company says they have a great brand, loyal customers, that sticky factor. They all claim they've got this amazing moat.
And that's the tricky part, isn't it? When things get tough, when competitors really pile on, only the businesses with a genuinely defensible setup are going to thrive.
Right. So you got to be able to tell the difference between the talk and the reality.
Yeah.
So where do we even start with this evaluation process? What's step one?
Okay, well, the place to begin, maybe a bit surprisingly for some, is with the numbers.
The numbers. Why start there?
Because ultimately, a moat's job is to protect profits, right? And that protection, well, it shows up in the financials. The first big metric to look at is return on invested capital, ROIC.
ROIC. Okay, what makes that particular number so revealing?
Well, it's basically a measure of how efficiently a company is taking the money it reinvests back into itself and turning that into actual profit. It really cuts through the noise to show, operational effectiveness and if there's a real competitive edge.
And what are we looking for? What's the signal of a strong moat in the ROIC?
The big signal, the real green flag, is a company that consistently delivers ROIC way above its cost of capital. And not just for a year or two. We're talking consistently over many, many years.
Consistently high, like what kind of numbers?
Yeah, I think 15, 20%, maybe even higher. And keeping it there year after year, especially if it's in an industry that's usually pretty tough or crowded.
Okay, so why is that consistency the key thing? Why does that point so strongly to a moat?
Because it tells you that competitors just can't easily swoop in and steal those returns. If a company keeps earning that much on the money it plows back into the business, it implies there's something fundamental, something structural protecting those earnings.
Yeah, okay. So they can keep making more money per dollar invested, keep margins healthier.
Exactly. And defend their market share against rivals who are trying to chip away at it. That staying power is key.
So what if you see high ROIC, but it's bouncing around all over the place, up 1 year, down the next?
That volatility, that's often a warning sign. It suggests those high returns might be temporary. Maybe it's just good market timing or a single hit product or something else that competitors can eventually copy or catch up to. A real moat usually leads to more predictable, superior returns over time.
Got it. Predictability matters. So beyond ROIC, what other numbers should we be looking at? You mentioned margins earlier.
Right, margins are crucial too. Moats often make themselves visible in profitability margins. Things like gross margin, what's left after the direct costs of making something.
Like Apple's famously high gross margins on hardware.
Precisely. Or operating margin, which shows the core business efficiency after all operating costs. Think Google or Facebook still pulling in massive operating margins despite tons of competition in ads.
And net margin too, the final bottom line.
Yeah, the final profit percentage. A company with a solid moat tends to show stable or sometimes even expanding margins over time, even when new players jump in or the economy takes a dip.
So they can hold their pricing power or cost advantages.
Exactly. They aren't easily forced into price wars or spending massively just to tread water. Think about Costco. They defend their low margin model through immense scale and fierce customer loyalty. That's their moat, protecting their specific margin structure.
So conversely, if you start seeing margins getting squeezed year after year,
that's a big red flag, yeah. Margin compression often signals that competitors are finding ways in, forcing price cuts or higher spending. It suggests the moat might be leaking or maybe wasn't as deep as everyone thought.
Okay, so numbers give us hard evidence. ROIC, margins, quantitative signals, but you can't stop there, right? You have to look at the people involved, the customers.
Absolutely. This is where it gets really interesting, because human behavior, specifically how customers behave, can be the thing that truly locks a moat in place.
How so? What kind of behavior are we talking about?
Well, it's not just about whether customers like the product. It's deeper. Do they come back automatically out of habit? Is leaving just too much hassle, or maybe even emotionally difficult?
So what questions should you be asking yourself when you look at a company's customer base?
You need to ask, are they repeat customers? Are they structurally locked in somehow? Like, is it super inconvenient or costly for them to switch? Would they actually recommend the service? NPS scores can give you a hint, but the real killer question is why? Why do they stick around?
Can you give an example to sort of illustrate that difference?
Sure, think about Slack versus Salesforce early on. Slack grew like crazy, right? People loved using it. But the core thing it did, team chat, turned out to be, well, not that hard for others to replicate effectively within their existing systems.
Like Microsoft Teams baked into Office 365.
Exactly. For a lot of companies already using Office, switching from Slack to Teams was maybe annoying, but not fundamentally crippling. The switching costs weren't prohibitively high for everyone, so maybe not such a deep moat there, ultimately.
Okay, contrast that with Salesforce.
Right. Salesforce often gets woven right into the core of how a company operates its sales, its customer service. Over years, tons of critical data builds up inside it. Workflows are built around it. It links up with loads of other software.
Ripping it out would be a nightmare.
A massive headache. The cost, the operational disruption, the risk of losing data during migration. That creates enormous friction. That's a moat built not just on users liking it, but on deep structural integration and high switch-in costs.
So the key idea here is, don't just look at satisfaction. Look for that stickiness, whether it's because people choose to stay locked in or because it's just too painful to leave. That stuck in by choice or by force idea.
Precisely. That friction, that pain of switching, that's a much stronger sign of a real moat than just current popularity or buzz.
And sometimes that stickiness isn't just about one product, is it? It can be about a whole network of things working together, the ecosystem effect.
Yes, exactly. This is where moats can get really powerful, layered. They often don't exist in a vacuum. Apple is the textbook example everyone points to.
We think of the iPhone itself as the moat.
And yeah, it's an amazing device. But the real defensive power for Apple comes from the whole interconnected system, right? iOS, the App Store with all your purchased apps, then AirPods connecting seamlessly, the Apple Watch tracking your health data synced to your phone, iCloud for your photos, Apple Pay, it all links together.
And leaving one piece makes the other pieces less valuable or harder to use.
Totally. If you switch to an Android phone, suddenly your AirPods aren't quite as slick, your watch doesn't work, maybe you lose access to apps or data easily. It becomes a real pain to leave that walled garden. The web of interconnected services creates massive lock-in.
So we should watch for businesses that are deliberately building those layers, adding interconnected services around their main product.
Definitely. That's often a sign they're trying to build an ecosystem moat. They add value layer by layer, and the combined effect, the interconnectedness, becomes incredibly hard for competitors to replicate.
This brings up another really important point, telling the difference between a company with a real sustainable advantage and one that just got there first, or is maybe just really good at copying others quickly. The innovator versus the imitator.
Yeah, that's a crucial distinction. Some companies look impressive initially, they grow fast, maybe they were the first mover in a space, but you have to ask, is their advantage actually defensible? How hard, how expensive, how time-consuming would it be for a well-resourced competitor to build something similar or better?
Can you give us a comparison to make that clearer? Maybe Zoom versus Spotify?
Okay, yeah. Think about Zoom. Its growth during the pandemic was just explosive, absolutely phenomenal timing and execution. But the core technology video conferencing, while they did it very well, wasn't fundamentally protected in a way that stopped others from catching up.
Right. Google Meet, Microsoft Teams, WebEx. They all improved fast.
Exactly. They could leverage their existing platforms and user bases. Zoom had incredible momentum, but maybe not a deep structural moat based on unique, hard-to-replicate tech or network effects that barred entry. More like being in the right place, right time, executed well.
And compare that to Spotify.
Well, Spotify has faced giants from day one, Apple, Amazon, Google launching music services. But Spotify has held its ground, even grown. Why? Their moat seems to be built differently. It's partly in their recommendation algorithms, the personalization that keeps you discovering music you like.
The data advantage they have.
Right, the data advantage from millions of users. Plus, they've made big bets on things like exclusive podcasts, building a global footprint with local content. It's a multi-layered approach. Their advantage isn't just streaming music, which others can do, but the whole package of personalization, content, and user experience, which is harder and more expensive to perfectly replicate.
It's about looking past the initial splash and asking,
Yeah.
how deep does this advantage actually run? Is it truly defensible?
Precisely. Is it based on something competitors can't just easily copy by throwing money or engineers at the problem, or is it more about timing and execution that can be matched eventually?
Okay, and related to that, we need to talk about the red flags, the things that look like moats but often turn out to be, well, mirages, temporary advantages.
Yeah, recognizing these illusions is super important. One common one is relying too much on patents that have a limited lifespan.
Like a drug company with one blockbuster.
Exactly. They look invincible while the patent holds. But the moment it expires, boom, generic versions flood the market, prices crash, and that moat disappears unless they have a really strong pipeline of new, innovative drugs coming through. The patent itself wasn't a permanent moat.
What about just having high margins because you're in a hot new market?
Another classic mirage. If a market is brand new and growing fast, the first few companies in might make amazing margins just because there's hardly any competition yet. That looks great, but unless they build a real cost advantage or customer lock-in while the market is growing, those high margins are incredibly vulnerable. As soon as serious competitors jump in, profits get competed down.
And brand. Everyone talks about brand as a moat.
Yeah, but you have to be careful there. Just having a recognizable brand name isn't automatically a moat. The real test is pricing power.
Can they raise prices without everyone leaving?
That's the key question. If customers say, yeah, I know that brand, but this other one is cheaper, I'm switching, then the brand is just awareness, not a true economic moat that defends profits. Think about luxury goods versus, say, basic consumer staples.
And what about companies built almost entirely around a single product?
That's a huge vulnerability, a massive red flag. If your whole competitive advantage, your whole moat, rests on just one thing, you're incredibly exposed. Anything. A shift in technology, like digital cameras killing film for Kodak. A competitor launching something slightly better or cheaper, even just changing tastes. Think about BlackBerry and its keyboard, or MySpace and its early social features. When the world moved on, their reliance on that one core thing became their downfall.
Okay, all these points lead to something really critical. This whole evaluation process. It's not a one-and-done thing, is it? You have to keep checking. Moats aren't static.
Absolutely not. This is maybe the most important takeaway. Moats are dynamic. They can strengthen, but they can also erode, sometimes surprisingly quickly. The world changes, technology evolves, competitors adapt, regulations shift, customer preferences change. You have to track moats over time.
So what should you be monitoring? What are the vital signs of a moat's health?
You need to keep an eye on several things. How much is the company spending on R&D versus its key rivals? Are they keeping up or falling behind? What are the trends in customer churn or retention rates? Are new, potentially disruptive competitors emerging? Are there shifts happening in their supply chain that could weaken a cost advantage? New regulations on the horizon? Even watching how competitors are behaving, are they acquiring smaller players to gain capabilities?
And looking back at history really drives this home, doesn't it? Moats that seemed unbreachable just vanished.
It's sobering. Blockbuster had that huge network of stores, a massive physical distribution moat, right? Netflix just went around it with DVDs by mail, then streaming, completely bypassed.
Kodak owned film photography patents and know-how.
Yeah, incredibly complex chemistry. Digital cameras made it irrelevant almost overnight. Yahoo had dominant web traffic, the go-to portal. Then Google came along with a fundamentally better search product, built a new kind of moat around data and algorithms, and Yahoo couldn't keep up.
So the tough lesson is, never ever assume a moat is permanent.
That's it. Constant vigilance, constant reevaluation. It's essential.
Okay, so let's quickly pull this together. We've got a framework now. You start with the hard numbers, looking for that consistently high ROIC, stable, or growing margins. That shows the result of a moat.
Right, the financial evidence.
Then you dig into the why, the customer behavior. Are they truly locked in? High switching costs, habit, ecosystem effects multiplying that lock-in.
Understanding the source of the friction.
Then, being really critical, spotting the fakes, the mirages, patents about to expire. temporary high margins, brand without pricing power, relying on just one thing.
Avoiding those traps, yeah.
And finally, accepting this isn't a snapshot. It's a movie. You have to keep tracking the moat, monitoring its health, because the competitive landscape never stands still. It really is about thinking like a deep business analyst.
Exactly. You're dissecting the underlying competitive dynamics. And actually, the next logical step, which we'll get into next time, is applying all this, taking this framework and using it to analyze real companies. Well, we could look at businesses like Amazon, Tesla, Netflix, maybe Adobe, Shopify. See how these moat concepts play out in the real world for some major players.
Okay, looking forward to digging into those case studies. But for now, let's leave everyone with a final thought to chew on, something related to how dynamic these moats are.
Yeah.
With artificial intelligence developing so rapidly, how do you think AI might shake things up? Could it potentially challenge some existing moats we thought were solid? Or maybe even reinforce others in completely unexpected ways?
Ooh, that's a big question. Definitely something to think about, how AI changes the competitive game.
Yeah, something to mull over. We'll explore those case studies next time.